Welcome to the daily update, where I'll go over the action in the market for Monday, February 12th, and then we'll see how things look for Tuesday, February 13th. We ended up having a bit of a down day. There was some profit taking in the mega caps, and they did better in the earlier part of the day. And then as we worked our way throughout the session, we started to see some profit taking. So this was one of those days where we saw the small caps and the broader market actually outperform the mega caps. Not anything to change us back to being more negative on the situation. We're still overbought. We're still positive. We're still looking pretty extreme positive right now. So we just want to see as things play out and go forward from here. One thing that I will point out is in Monday's session, right before the market opened, I posted one of my additional videos. I call it What to Watch. And I don't know how often I'm going to post these videos. They're kind of on an as-needed basis. I thought I might do 1, 2, maybe 3 a week. Well, I posted one in Monday's session, but the previous one was 3 weeks before that. It has a different looking thumbnail. It's white with a background on there. They're typically shorter. I go through the same things in the daily videos that I cover in that, but these are designed just to pull out the things that I'm really focused on right now. But to get the big context of what's really happening, you need to watch the daily video to see everything all together. Yes, I know my videos are longer. I've designed them that way on purpose. And so it takes more of a commitment to go through them. But I also feel that everything needs to be put out there to try to get the best picture that we can at any given time. Let's go back and talk about what happened. Right at the open, we did have a higher open. It looked like, okay, we're just going to keep going up from here. Prices climbed above R1 at 5,038, and then we ended up hitting resistance right at R2, which was at 5,049. As the day went on, we fell back. We came back down below R1. We fell below the unchanged level, actually ended up going negative. We were able to find support at the daily pivot at 5,019, and then we closed slightly negative on the day. We were down 0.09%, so not a real big move, but it still goes in the books as a down day. Volume was still below average. Now, one of the things that I've been really talking about a lot lately, last week when we were going up and we ended up closing above 5,000, that was on below average volume. Now we had a slight down day with some selling in it, and we're still below average with that. So when we're going up, that tends to be more negative. When we're coming back down, that's more positive. The big thing is going to be, because in Tuesday's session, we're going to get CPI. And you probably had some folks that have seen some nice gains in the mega caps. They wanted to lock those in ahead of the CPI coming out because that can really produce some gyrations in the market. And that makes some sense, especially if you've been riding this wave higher. We'll have to see if things adjust after the report comes out. That could be pretty influential for what's going on. As always, there's positive things that we can look at, and there are some warning signs that we need to go through, and I'll go through all these charts as we go throughout this video. We are positive with our technicals, but we are looking overextended to the upside. And I've been trying to also point out that being overbought is different than being oversold. Typically, when we're getting oversold, that means we're going down, and everybody seems to kind of congregate at those times, and a lot of capitulation happens. There's a lot more emotion going on, specifically fear. And so everybody kind of acts all at the same time. Where when we get to an overbought condition, especially when things are turning longer term positive, which is what we're seeing in our longer term charts, we can ride that wave for a while and we can have more of a rounded top, and we pull back and we might chop sideways and be able to work off some of this condition by just not really going much higher, but not going much lower at the same time. However, we're potentially entering a time of seasonal weakness about the middle of February into the middle to latter part of March, where if we're going to see some weakness, at least historically, that is when this tends to happen. As that happens, or as these next days and weeks unfold, we'll be evaluating things each day just to fall back and regroup and try to get a proper picture on what the climate is actually like. In Tuesday's session, it's going to be about inflation. That's the CPI report. That's going to bleed over into interest rates. to hopefully get a little bit more of a clue as to what is the Fed going to do going forward. They pretty much have said they're done raising rates. Now it's a matter of, okay, they're going to keep rates the same and possibly even cut. This is the scenario that we're working with right now. Of course, there's all kinds of geopolitical things going on right now, but the market just doesn't seem to be all that focused on these things at the current time. That can always change. Some kind of a big event could happen that the market reacts to, at least for a short period of time. So we want to be aware of those things that are happening. Some comments that we can make. The S&P is still above 5,000. We just came down a little bit here. And so we're still above that 5,000 level that we were able to get above in Friday's session. The Dow ended up setting a new all-time high. We did not set a new all-time high in Friday's session with the Dow. We did with the S&P. We then were up with the Dow in Monday's session, so that set the new all-time high there. The broad market ended up outperforming the mega caps. Earlier on, it was kind of a different story, but then we saw some profit taking coming into the mega caps. Small caps are now positive if we go back to the beginning of the year. It's taken up till the middle of February or so for that to happen. After this January effect was supposed to happen, that happened in December, but didn't follow through into January. So that's also looking more positive for right now. Here's our short-term list, and there's really no changes on here. If you've been watching the videos every day, we still have the Stochc RSI, the Williams percent R, the CCI 14 and 20, the stochastics, the standard deviations chart, the boom indicator, which measures how far away we are from the 20-period moving average, and then our shorter-term RSI. All of these are extreme positive. You could also consider them to be overbought. Intermediate term, not a real big change to this list. We have the rate of change going back 50 periods. The Arun, that's a new addition to the list right now. The PMO and all of our oscillators, they're turning back positive. We're coming back above the moving averages, but we have a lot of our oscillators that are looking extreme positive. The Sean Trend Meter, the bullish percent index for the NASDAQ 100, it's still above 70. The Money Flow Index, the Chaikin Oscillator, which came down a little bit, but is still extreme. The Boom Indicator based on 50 periods, our more intermediate term RSI based on 14 periods, and then it seems like this has been on here longer than a couple of months, our new high, new low study for the S&P based on 10 periods. Long term, we're still looking extreme with the 150 and 200 period moving averages. And we're still dealing with this same scenario. We don't know if this is going to change at all. Maybe not the scenario itself, just kind of the timing of the scenario. It does look like the Fed's done raising rates. And then at some point, they could look at cutting rates. Right now, the market is focusing more on May. They wiped March off the table. The next meeting after that is in May. The dollar was up a little bit, which could have put some pressure on stocks, and interest rates actually ticked down a little bit. This is another thing that I was hitting a lot over the weekend when I posted those videos, especially in the latter part of last week. We saw stocks going up and interest rates going up, and interest rates going up to a level that before has been causing some real fear, or at least some uncomfortable feelings with the stock market, but it seemed to not notice that this time. We came down a couple of ticks to 4.17% with the 10-year yield. So we'll have to see if that's going to continue, or are interest rates going to keep going up. Is that eventually going to be reckoned with by the stock market by going down? If interest rates start to fall, is that going to help give more support to the stock market? We still have the yield curves anywhere from 1.5 to 2 years, even longer than that in some cases, where the yield curves that we're really focused on right now are still inverted. Sentiment is still extreme positive. We're above that 75 level. We had been at 77. We ticked up to 78. When we get above that 75 level, that's when we look to start thinking, okay, the market's getting a little too exuberant right now. And this can work off by going sideways, but sometimes we also see some kind of a reversal when this happens. Our trend is still positive. We're above the moving average. We're above 20, so we show a strengthening trend. And because of the slight down day, I've changed our bias over to mixed, and our momentum still continues to be positive when we look at the last 2, 3, 4, 5 days together. We did get The Treasury budget, as far as an economic report that came out, it came in with a deficit of 22 billion. That's less than what we saw last time at a minus 38.8 billion. This is not seasonally adjusted, so we have to go back and look at what it was a year ago. Outlays were at 499.3 billion, which was more. So we're spending more than what they're bringing in at 477.3 billion. Not a real surprise there. Here are some charts just to show you. This is the trailing 12 months showing the federal budget, how it's been evening out just a little bit after it had been coming back up. And then these are the receipts and outlays, where we're seeing the receipts they're still going up on a year-over-year basis, and the outlays are coming down. But when we compare this to a year ago, it's kind of looking opposite for that one. This is not a huge report. It didn't have a big impact on the market itself. Here's some Isabel Net blog charts. This is the insider transaction ratio. We're coming back down to a neutral area now. If we continue to drop, this would be more bullish for the market. We got to a really high reading up here where it ended up being more bearish. And then this is US data has surprised to the upside. This is called the surprise index. And we have our consensus, or what the market expects will come out when these economic reports are released. If it's stronger than expected, that's a surprise to the upside. If it's weaker than expected, that's a surprise to the downside. And so far in 2024, we've been seeing this going up as the economic reports have been stronger than expected, according to this chart. And then this is, what do people think the Fed is going to eventually cut their rates to when they, first of all, they have to start lowering rates. And then when they get done raising or lowering rates, what's that going to be? Most people are pretty much around this 3.25 to 3.5. If inflation gets back down to the 2% level, which the Fed is shooting for, to have rates 1% to 1.75% higher than that would probably be about normal based on where things stand right now. Now, a lot of things could come in and wreck this whole picture very quickly, but this is just where things stand right now. Then looking at Deutsche Bank and their growth forecasts, they're now modestly above consensus expectations. The dark blue lines, this is what's already happened for GDP. This is looking forward, where Deutsche Bank tends to be a little bit more optimistic looking at GDP, where then we have the Bloomberg consensus, which is still positive, but it's not as optimistic. The takeaway that I get from this chart is that they are all positive. One area, one definition, one thing that is used to determine if we're in a recession is that we have negative GDP for 2 quarters. They have to be back to back, and the projections are showing positive GDP. Here's our intraday chart, where we did have a higher open and we made it up to R1. We came all the way up to R2. Boom, that's where we hit overhead resistance. We were not able to get above this level. Yes, these pivot points are very important. The cool thing about them is they're on the chart before the day even starts. Then we came back down, we hit the unchanged level, came down to the daily pivot, also something that was already on the chart. This acted as support, and then we ended up closing just slightly lower for the day. Here's our intraday chart, where we didn't see an awful lot of change from Friday's post-market session, and then we had the pre-market session. The futures were pretty much flat. Then we saw some strength during the day. That led to more weakness, and we're trailing off just a little bit in the initial overnight session. I pointed this out in the what to know or what to watch video, and I also pointed this out over the weekend. We were seeing the blue line above the red line. We saw growth underperform in Monday's session, and so now we're seeing the blue line dropping back below the red line, but we're still positive taken together on an intraday basis. And this measures growth and value separately, but we put them on the same chart. This is the ratio that we look at, where we did see a bit of a pullback here when we look at the growth to value ratio for the S&P. I was watching growth even when we were going up. It was really underperforming, and that's why we see this really going down. The strength that we saw earlier in the day was mostly coming from the value areas. That also kind of led me to believe that at some point we're going to turn and probably go down. We ended up actually going negative on the session. Sometimes if you watch this intraday, this can give you some clues as to what will happen. Here's some end of day charts. Growth was down for the large caps where it was up. When we look at large cap value, it was up, but up about half as much for the mid caps, up, but also up, not quite half, but not as much as it was for small cap value. We came back down a little bit with our growth to value ratio with the small caps. We've been seeing a nice little breakout here, and now it's been pulling back slightly. We also saw a bit of a pullback with the mid caps, although this is still hanging in there for right now, both with the small caps and the mid caps. We turned down with our growth to value ratio with the S&P 500. And it doesn't mean we have to go straight up with this ratio for it to be positive. We're going to see bumps along the way, but we want to see the bigger picture going up for us to remain more positive. Now, if this starts to really show some follow-through weakness, that could be a bit of a warning sign for us. Also, keeping an eye on the discretionary to staples ratio. We're coming back up to this previous high and actually went a little bit above it. So we are seeing some improvement here where we had been seeing a longer-term negative divergence. Here's our trend. We're above the moving average and we're going up. The green line is on top. So we're still positive there. One thing to be aware of, the green line is getting above 40. That's looking extreme positive. We're also above 40 with the green line in the short term, but we're still in a trending environment that is getting stronger. Volume is continuing to drop off, and we saw that in the latter part of last week, Thursday and Friday session, and then in Monday's session. It could be some apprehension ahead of CPI coming out. This is going to be a pretty heavy economic week. Keeping an eye on sentiment. This came from Isabel Net, where we're starting to get extreme with our sentiment reading here. And that pretty much is confirming what we're seeing in the other sentiment indicators that we look at. The Ulcer Index shows that there's not a lot of fear in the market. We actually came back up slightly with the VIX when we look at the line chart as well as the bar chart. And we're seeing volatility picking up just a little bit with the bar chart and the line chart when we look at the VIX of the VIX. We ticked back up with the one-day chart of the equity put call ratio, but we're continuing to decline with the 5 period. So that is still remaining positive for right now. I wanted to keep showing this chart. We're no longer extreme when we look at the VIX to S&P 500 correlation. We're coming down, but we're wondering, okay, is this really going to turn into anything more than what we've seen so far? Also, the SKU index continues to be up in this red area. The market is still anticipating some kind of a big move. Is CPI going to be the catalyst to drive that big move? We don't know at this point, but the market is anticipating some kind of a move. Looking at our advanced decline line, we are showing some improvement here with the advanced decline line based on price. The mega caps were a little bit weaker, but the rest of the S&P ended up holding up quite well. We're also showing some improvement and coming back to these previous highs when we look at volume. We're still headed lower for the most part when we look at our 5-day moving average of the new highs minus the new lows. You can see on top that the new highs are really outnumbering the new lows, but we still continue to go up with our 10 period. We're above the midpoint and advancing with the advanced decline ratio. I haven't shown this in a while. We're seeing some improvement here. This is just showing that the broad market outperformed in Monday's session. We look at the cumulative NYSE advanced decline line, and that is going up for right now. With our regular advanced decline line, this is starting to break out above these previous levels. So this is also showing some improvement. Here's another NYSE advanced decline line, but calculated in a slightly different way. It's also showing some improvement as well. We look at the common stock based on price on the NYSE, where that is showing a rebound, but not back to the high set in late 2023. This is going up. We're still seeing a little bit of a lag here when we compare it to volume. You can see this line's going up a little bit faster based on price than it is going with volume. That's a little bit of a concern and more of a short-term negative divergence. Accumulation distribution did turn down, but we're still above the advancing moving average. We rolled over just a little bit with the Chaikin money flow, but we're still looking positive for now. We came down with the Chaikin oscillator after getting almost a really extreme positive, but we're still extreme. The NYSE advanced decline line is showing some improvement and is still in an uptrend. And here's our advanced decline line studies going up with the common stock, but not back to these previous highs yet. Looking a little better with the S&P and setting new highs. Coming back to previous highs with the mid caps, still lagging behind, but showing some improvement with the small caps. Here's our daily chart. We're still looking pretty solid when we just take all these bars together. I mean, this is a pretty solid uptrend. I also added another trend line here going from the October low to some other lows that we hit. I have another breakout chart just of this trend line that I'll show you later. And so for right now, what we want to keep an eye on, if we start to pull back, we're going to be watching not only these pivot points, but also this trend line. If we fall through that, then we'll be watching the 50-period moving averages. The Stochc RSI did come down a little bit, but it's still extreme. We're coming down with the Williams percent R, but still extreme. Turned down a bit with the CCI 14, but still extreme, and still going up with the CCI 20. We're showing some improvement with the 20, 50, and 200 period moving average studies. So again, this is picking up the little more strength that we saw inside of the S&P. We continue to be positive with the force index. We're above the midpoint and advancing. And we're still extreme with the stochastics, even though we turned down in the short term, rolling over a bit in the intermediate term, still going higher in the long term. We're still in the +3 channel of our standard deviations chart, so we're still extreme positive that way. We're still looking okay with the balance of power, even though we ticked down slightly. Still looking positive on a trending basis when looking at the no-go system. We're still at the upper end of the highest high value and above an advancing midpoint. That's positive. The TTM squeeze is still a lighter shade of blue. We are starting to come up to this black line. Now, I always warn about this. I put this black line on here. I just kind of eyeball it and say, okay, this looks like a good spot. This is just kind of a warning area to suggest that if we go above this, we're getting extreme with the TTM squeeze. We're still extreme positive with our rate of change going back 50 periods. We're turning back up with the ease of movement. That could be kind of encouraging. We were going up and the ease of movement was starting to go down. Now it's starting to turn and go back up. The Erin is starting to get to an extreme positive reading. We have the green line on top, which is pegged all the way to the top. That means buyers are in control. Sellers are really dropping off and kind of non-existent so far based on this indicator. So the difference between the two gives us an extreme positive reading with the Erin indicator. We are seeing some improvement here. We're finally crossing back above zero with the McClellan oscillator for the S&P. Longer term, I've really been trying to point this out. We were going up with the S&P. We were negatively diverging with the McClellan oscillator, and we're still doing that. But in the short term, the fact that we did cross back above zero is positive. You've got to start somewhere if things are going to look a little bit better. But we're starting to turn back up just a little bit based on price. We are already turning up based on volume. I like to point out that the top part of this chart and the bottom part of this chart are two completely different indicators. I just have them plotted on the same chart. Sometimes we can get a little bit of a lead when we look at volume leading price, and that could be positive. But be aware, we don't want to use this in isolation and make decisions based on this, because this is also giving us some false signals as well. We are showing more improvement with the NYSE McClellan oscillator. We're above zero and showing some improvement there after seeing a negative divergence longer term. So we're starting to turn back up based on price as well as volume. So things are showing some improvement. We're back above zero with the Swenlin trading oscillator based on price and volume. That's turning more positive. We're positive with the PMO, but we're extreme positive. We haven't quite crossed above the moving average based on price, and we're still right on top of the moving average based on volume. So the indicator is looking more positive. Internally, it's not looking as strong. Nothing extreme here. The PMO's rising. That showed some improvement. We're seeing a bit of an improvement with the buy signals. We're still descending after being extreme positive with the PMOs that are above zero. We've switched from being positive back to neutral with the Elder's Impulse system for the S&P, and this bar is a little bit scary looking. We opened, we set a high, and then we ended up closing down below the open to close near the bottom part of the bar. Just something to be aware of there. We're still positive with the parabolic SAR. And here's our slope. We're above this green line. We're above the moving average. We are positive, but we're extreme positive. We're not necessarily extreme with the MACD, but we are above the moving average. So in the short term, we're looking extreme. We're looking more positive with the MACD, the PMO, and the PPO. And they're not necessarily extreme. And long term, we still remain positive with the TRIX and the KST oscillators. We're still above all of the plotted moving averages in our moving average tree. And one thing I was also trying to point out, you can see the exponential moving average is above the simple moving average. The exponential moving average moves quicker. So that just means that there's more power behind this upward move when we look at our moving averages. We're turning back up slightly with the bullish percent index. So this is actually showing a little bit of an improvement here. We're turning back up and above 50 with the bullish percent index for the NYSE. We're still extreme positive with the NASDAQ 100 bullish percent index. We're still extreme with the money flow index. After being extreme, we did drop that back down with the ultimate oscillator. We turned back up slightly with the vortex. That was a little bit of a concern, but the green line is on top and showing some improvement. We're still extreme positive with the RSI 14. That's our intermediate term measure. And then we're still extreme with the 9 period. That's our short term measure. We're still looking okay with the on balance volume. We're above an advancing moving average. And I was pointing this out in the what to watch video, where we've been going up with the S&P. We've been seeing a negative divergence when we compare it to the 200 period moving average study. This did turn up just a little bit in Monday's session. We've also been seeing a more pronounced negative divergence when we look at the 50 period moving average study, but we did see some improvement in Monday's session. The copy curve is rolling over, but it's still above its moving average, so it's still positive. We're still looking extreme with the Sean trend meter. We're still looking extreme when we measure the distance between price and the 20 period moving average and the 50 period moving average. We're still positive when we look at price and compare it to the 200-day moving average. On a trend basis, we are positive when we look at the Heiken Ashi chart. We're positive with the Kagi chart. We're positive with the Renko chart. And we're positive with the 3-line break chart. Long term, we're still extreme positive with our 150 and 200 period simple moving averages. This is a new chart. There's nothing real magical about this. This is just going from the October low, connecting some of these previous lows here, and just drawing out a trend line like I did on the daily chart a little while back. What we're going to be watching for is if we see some kind of a pullback here, is this going to offer some kind of support? Now, I tend to believe, and this is brought out by years of experience, that a horizontal line is more powerful than a diagonal line. But trend lines are still important anyway. But if I had to choose between the two, I would go with a horizontal line. However, if we do start to pull back, we're going to be watching to see if this is going to offer some kind of support. If we fall through that, the 50 periods and the 20 period moving averages will be in there somewhere too, but the 50 period will probably be below this. And that's other areas that we will be watching for support. Our different indexes, we saw the equal weight actually outperformed the S&P. So we came down a little bit when we look at the ratio between the S&P weighted index and the equal weight index. We did set a new all-time high, and we just barely came above this R1 level with the Dow. The diamonds have gone from being neutral back over to positive with the Elder's Impulse system. We also closed near the bottom part of the bar with the NASDAQ. We were looking more positive, and then we ended up closing closer to the low for the session. And we're still in no man's land with the NASDAQ itself. Now, we have this new take on Dow theory, where instead of using the Dow, we use the S&P. Instead of using the transports, we use the NASDAQ itself because it's more tech-oriented, more like what real life is. If we could come back and set an all-time high with the NASDAQ, that would confirm the all-time highs that we're seeing with the S&P 500. We still have a ways to go, but this is just something to be watching out for. If we really start to head down, then some of these fib levels may, in fact, come back into play. The NASDAQ 100 also closed well off of its highs and is still above this R1 level. If we see more weakness, we'll be seeing if that will provide support. We switched over to neutral with the Elder's Impulse system after being positive when looking at the QQQs. We're still looking positive on a momentum basis. The PPO is above its moving average. Not really showing a lot of conviction right now, but it is positive. The small caps had a good day, up 1.79%, and we're able to close right at this R1 level. Okay, we've been fooled before. Are we going to be fooled again here? See a nice little shoot up with the small caps and then a lot of give back. Shoot up and then give back. If we could get above this R1 level, which is right at about 1312 or so, and then close above that, we would get above this R1 level, and then we would start to see if we could tackle this R2 level. But we did see some improvement on Monday. So we continue to be positive with the Elder's Impulse system when looking at the small caps. And another area, this what had been resistance that we've just been having a difficult time getting through, we are breaking out above that, but we're still not back to this high that was set back in 2023. We're going up with the RSI and not quite extreme positive with the Russell 2000 small cap ETF. We are turning positive with momentum, and we're positive with our longer term trend. And we're also coming right up to this R2 level. Notice how that's where we set the high for the day and then came down. But the mid caps were up 0.92%. So they're showing some strength and breaking out above this high that was set back in 2023. We continue to be positive with the Elder's Impulse system for the mid caps. The FANG index ended up being down, so it did not set a new all-time high, but it's still in a really solid uptrend. Financial sector was up, and so far this area, which is a broader measure, you kind of whittle down. You take the financial sector, then you look at the banks, then you look at the regional banks. It's the regional banks that have been under some pressure lately, but so far the financial sector is holding up. And then this is a chart that I'm showing off and on here. This is a staples to tech ratio. Staples are things that people get into when the market is looking more weak and they're more defensive. And that's what we saw really outperforming in 2022. We compare it to the tech sector. The tech sector was under a lot of pressure. Then in 2023, we saw this ratio going down as staples were underperforming the tech sector, and we continue to fall down here. We haven't quite surpassed this previous low. So as this is going down, that tends to be more positive for the market. We're keeping an eye on New York Community Bank. So far, this is the only breaking news to come out of the regional banks, where they ended up being down slightly in Monday's session after coming down, getting hit hard, bouncing back up, and then closing down a bit on Monday. The dollar continues to go back up, but we're still in a longer-term downtrend. If we stay above both of these moving averages, we might see a golden cross. Keeping an eye on interest rates. They fell down with the 10-year based on yield. We were up slightly with the 10-year based on price. And looking at our growth to value ratios, we are seeing a bit of an improvement with the Qs to S&P. We're still showing overall weakness here when we look at discretionary to S&P. We're flat. We're starting to come back up, but we're still below a declining moving average. And we ticked down just a little bit when we compare large cap growth to large cap value, but it's still been performing well lately. So with the large caps, we ticked down the mid caps, and we're still looking pretty strong here, even though we ticked down a little bit with the small caps. We're still extreme positive, even though we're drifting lower with our 10-day average of the S&P 500 highs minus the lows. We've been this way since, my goodness, the latter part of December, and we just haven't been able to wear this off yet. That could suggest the good momentum that we've been seeing since this indicator continues to hold up. We're still positive when we look at the highs minus the lows, take a 5-period moving average and measure it across the broad market. We came down just a little bit with our S&P to utilities ratio, but this has really been breaking out lately, which has been helping the S&P. We're also continuing to decline with our staples to S&P 500 ratio. As this continues to go down, that is often positive for the S&P itself. So what's our outlook for Tuesday? I really haven't changed this. We're positive. We're overbought. We want to watch these different areas to see are areas of weakness starting to develop. You can make a case for that, but right now we're just watching for those things. We're not necessarily making decisions on what we're seeing, but we are seeing volume decreasing, and I kind of already explained that before. It's more negative when we have an up day and we see volume tapering off. We will get the NFIB Small Business Optimism Index, but the big one is going to be CPI. That's one of the bigger reports of the entire month. We do want to watch all the different geopolitical events to see if anything comes in and has any kind of a broad-based, significant, either positive or negative in the market. Here's the economic calendar. We're just going to get the mortgage applications in Wednesday's session. Then Thursday, we're going to get retail sales. That's a biggie. And we're going to get PPI, which is big, but not quite as big as CPI. That'll be coming out on Friday. I didn't highlight it, but consumer sentiment is also a pretty important report. Seasonally, we're neutral to positive when we look at the Dow for February 13th, where we're flat out positive when we look at the S&P and NASDAQ. We are coming into options expiration week, where we tend to be up a little more than down. Seasonally, when we have an up January, that tends to bode well for things going forward. And I've tried to update this. We're coming into the middle to latter part of February now. This yellow area, this is where we sometimes see some weakness. And here's the Stock Traders Almanac, where we might see some seasonal weakness going forward. It's more pronounced on this chart. I haven't updated this purple line here, but right in about the middle part of February, which is what we're entering right now during an election year when the current president is running for re-election, at least we think that's what's going to happen, that's when we often see some weakness that can take us into the middle to even latter part of March. We'll have to see if things play out that way, but historically, that is what has happened. February tends to be the worst of the best 6 months, even during an election year. Tuesday, when we look at 2023, ended up being negative overall. Then we will be on the 9th trading day of the month, where we do see some negative seasonality during an election year when we look at the green dashed line for the S&P. So our scenarios, not going with the down one. Yeah, there's a lot of reasons why the market should be going down, but it's not for the most part. All these indicators that we look at, price is the most important indicator. We can come up with any kind of scenario, any kind of negative divergence, any kind of logic that will suggest that the market should be going down. But if price doesn't do that, we have to go with price. All right, so we're still going with the upward scenario. We'll have to see how the market reacts to CPI. Hopefully it will be more of a black and white type of report instead of getting mixed signals within the report that leaves the markets more confused. We're not going with the sideways trend for right now because our ADX is above its moving average, and both of them in the short and intermediate term are above 20. Warning signs. Volume has been decreasing as the S&P has been moving higher. I didn't really count that for Monday's session. I'm still going back to last week's session when we're setting all-time highs, crossing a significant barrier like 5,000 and seeing volume dropping off. The risk-on posture has been chopping sideways. It did improve, but it's not really giving us any useful insight right now. Our S&P 500 oscillators are extreme positive. They are positive, but they're extreme positive. The McClellan oscillators and summation indexes, they are showing some improvement, but in the bigger picture, they continue to diverge in a negative way. Small and mid caps are still negatively diverging from the S&P, even though we've been seeing some improvement there. The discretionary sector also improving, but is still negatively diverging from the S&P. In the longer term, the transports continue to negatively diverge from the Dow and the S&P. And then we're entering that period of time that we quite often see historical weakness, about the middle of February until about the mid to latter part of March. Positive signs. Even though we pulled back in Monday's session, growth has been showing some improvements. We're still positive with our oscillators, even though we're extreme positive. Our equity put call ratio based on 5 periods is still going down. The parabolic SAR, the vortex, and the Copic curve are all positive. The bullish percent index for the NASDAQ 100 is positive, but it's above 70, so it's extreme positive. We're still looking at an improvement of the PPO, which measures the momentum of the NASDAQ 100. Small and mid-cap growth is showing some improvement as well and are looking more positive. The financial sector for right now continues to be positive as well. So our conclusion, and I haven't changed this from the video that I posted for Monday, we're positive, we are overbought, we want to watch for some areas of weakness that could be developing, and volume is decreasing as prices are going higher. The CPI report comes out. Let's pretend that the market really likes it and we shoot higher. We want to see a real pickup in volume as well. In the short term, we're positive but overbought. We're keeping an eye on any weakness. We're keeping an eye on volume. We're positive and overbought in the intermediate term. Long term, we're also overbought but continue to be positive. Thank you. I really hope you found this helpful. I hope you enjoyed the Super Bowl. It was kind of a boring game until right up at the very end there. But I hope your team, Kansas City, the team that won, I hope that's the team you wanted to have win. But in spite of that, I hope you have a very good day, and I will talk to you in the next video.